Welcome to the Divorce the IRS Podcast, the retirement income planning podcast designed specifically for those who want to pay the least amount of taxes possible and build a retirement income that lasts. Inspired by the best-selling book, Divorce the IRS, you get to go behind the scenes with financial planner, author, and speaker Jimmy Miller. Learn how to set yourself up to pay the least amount of taxes in retirement when you'll need your money the most. And now, here's your host, Jimmy Miller.
Welcome to episode 17 of the Divorce the IRS Podcast. In today's show, we're going to unpack the final tax time bomb, paying taxes from the grave. Let's dive right in. Now, many people would love to leave a legacy to charity or the ones they love the most. But even if your goal is to die broke, it's likely you will leave something at the end of your life to someone. This can be yet another tax time bomb explosion. It's one that you light the fuse on, but doesn't go off until the moment you pass away, leaving a tax burden for the ones you love. If you've managed your golden years correctly, you've already diffused many tax time bombs. Now, you may also have a growing estate and are thinking about passing that money to the next generation. Proper estate planning is designed to avoid paying more to the government than necessary and to make sure you're passing on as much as possible to your loved ones. At the end of your life, if you have money in a tax-deferred retirement plan like an IRA or a 401k, you can bequeath it to anyone you choose. But you should know that they will have to pay taxes on every penny they inherit from these types of accounts, unless you give your money to a qualified charity. This can create quite a tax explosion, depending on who inherits your money. Let's look at how inheritance taxes work. Now, if your spouse inherits your IRA, assuming they're a U.S. citizen, the process is fairly straightforward, and they can just combine that money into their own IRA. They still have to pay taxes on the money as they withdraw it, though, now at the single tax rates, as we learned about with Tax Time Bomb 7, the widower's penalty, in the last episode. If you pass the money to someone other than your spouse, another explosion starts. With the passage of the new Secure Act, that changed the rules for taking money from inherited IRAs. In general, a non-spouse beneficiary, like your kids for example, will have up to 10 years to take out all the money from your IRA, and they'll pay taxes on every penny. The stretch IRA is now a thing of the past. Now, this can be a bigger explosion than you realize, as the tax rate on that money is now at the beneficiary or the kid's tax rate. And the kids may still be in their working years, making really good money. Let's say your beneficiaries are your kids. Now that the money is theirs, the withdrawals may be taxed at an even higher tax bracket than you were in, or even worse, the money may push your kids into an even higher tax bracket. Now, you can diffuse this bomb with the same strategies we've been talking about, or not. Some of the people I work with don't care about the tax burden they may leave to their heirs once they've departed this earth, and that's okay. I totally get it. They say their kids should be happy to get anything, and if they must pay a lot of taxes on the money, so be it. If this is how you feel, there's no need to worry about this tax time bomb. Others care deeply about this issue. Some people want their loved ones, or chosen charities, to receive every penny they possibly can. Others have a huge dislike for the IRS and don't want to offer them a single penny extra if they don't have to. If either of these describes you, don't worry. There's ways to diffuse this tax time bomb. The two most popular strategies are the same ones used to diffuse the last tax time bomb of outliving your spouse. If you planned earlier, shifted your money to the tax-free bucket, and utilized Roth strategies, you can sleep well knowing that anyone can inherit your Roth accounts completely tax-free. Even if they take every penny out on the day they inherit the money, it doesn't matter. It's all tax-free. The other popular strategy is to make sure you have a permanent life insurance policy in place. Then, when you and your spouse have passed, your heirs will receive enough tax-free life insurance proceeds to cover any of the taxes due on the other money they inherit from you. There's even a special kind of life insurance designed specifically for this tax time bomb called Second to Die life insurance. Second to Die life insurance is exactly as it sounds. It's a policy based on two people's lives, and it pays out when the second person or spouse passes away. The kids will then inherit the tax-deferred accounts, and they'll need the life insurance money to pay the tax bills they also inherit. These policies are usually for married couples who want to defuse this last tax time bomb and not pay taxes from the grave. It's best to work with a financial planner or a state attorney if you're considering this strategy, as you care deeply about this issue and you want to get it right. Now, we've discussed all 8 tax time bombs that can cause you to pay more than necessary to the IRS, both before and after you retire. They are exploding tax rates, early withdrawal penalties, sharing your retirement with the IRS, Social Security taxes, Medicare premiums, required minimum distributions, outliving your spouse, and now paying taxes from the grave. It can feel overwhelming to see all these potential bombs ready to explode, but as I have explained, there are ways to defuse all of these bombs. In the upcoming episodes of this podcast, we will cover what you need to do with all this information, including how to identify your ideal number and how to work with these strategies to defuse the tax time bombs. We'll then review some case studies so you can see how these strategies work in the real world. Make sure to stay tuned so that you can put the strategies to work within the context of your financial plan and defuse these tax time bombs. Don't forget to like and subscribe to the show so you don't miss any important information.
Want even more ideas, tools, and resources on how to navigate your financial life? Check out all the resources on the Divorce the IRS website at divorce-the-irs.com or the Baobab Wealth website at baobabwealth.com, and subscribe to the blog to stay up to date on issues affecting retirement income planning. Don't forget to subscribe to the podcast so you never miss an episode. Baobab Wealth and Baobab Wealth Abroad are DBAs of Baobab Wealth LLC, a Florida registered investment advisor. This podcast is designed for general education purposes only and shouldn't be taken as legal, investment, or tax advice. You should seek out a qualified tax professional or licensed financial advisor to determine what is best for your personal situation.